Okay, so this is part 2 of my presentations today, and it actually feeds in really well with the one on economic freedom, and you'll about to see right away how that fits together. But this is on regime uncertainty. It's also called economic policy uncertainty, and it derives from this paper. It's called Regime Uncertainty by Robert Higgs, who is a senior fellow at the Independent Institute where I'm employed, and he wrote this in 1997 for the journal that we published called the Independent Review. And I and a lot of other people think it's probably the most important concept in macroeconomics to be developed in the last 20 years. And so I'm going to talk about, what does it mean? How did Robert apply it to explain an important episode in U.S. economic history? And how is it still useful as a concept today, and how can we kind of see it at work today? So start out kind of where we left off, with the last presentation about what is economic freedom. Now, as I mentioned, economic freedom is a bundle of rights. And nobody thinks that we have pure economic freedom in the United States, but people do have in their minds some conception of these three rights in their mind about what they expect these rights to be today and into the future. And Robert's insight was that there are episodes in US history, and certainly in other countries as well, where what people perceive these bundle of rights to be in the future is very uncertain because of statements and actions by the government. And this uncertainty then causes them to behave differently than they otherwise would, and this has an impact on the economy, which I'll talk about in more depth. So what is regime uncertainty? Essentially, it's widespread uncertainty amongst investors and entrepreneurs about what the structure or security of property rights will be in the future. And if entrepreneurs and investors have more uncertainty about what they think will be the property right structure in the future, they're going to end up standing on the sidelines, waiting to see how this all plays out. And as a result, they're not going to invest money, they're not going to build new plants, they're not going to hire new workers, they're not going to buy new equipment. So everything kind of shuts down for a while until there's more certainty about the property rights. And so regime uncertainty relates to very fundamental questions, such as, will I be allowed to control and use my property as I see fit in the future? Will I be able to keep the income that's generated from my property? Will I be able to transfer my property on terms that I find acceptable or not? And will the government simply take my property away from me? Or will they allow me to keep my title to my property, but so attenuate my rights that I can't use my property how I see fit? So, these are very fundamental questions. And Robert's insight was that there are certain periods in US history where these questions come to mind much more to people, and as a result, they feel very threatened, and they pull back on making important decisions and investments that they otherwise would have made. This regime uncertainty has varied a great deal throughout US history, and one episode in particular where Bob noticed that regime uncertainty was very high was during the Great Depression. And as a result of that, the Great Depression lingered and lasted much longer than it otherwise would have, because investors stayed on the sidelines and businessmen refused to hire new workers and start new plants and open new businesses, and everything slowed down as a result. So what are the sources that Bob identified prior to and during the Great Depression that created all of this uncertainty? So the first was a huge outpouring of new laws between 1933 and 1940 that significantly compromised people's expectations about what their property rights would be in the future. So look at this list. This is from his original paper. Just in this 8-year period, look at all these laws that were passed. I mean, significant laws that really changed the relationship between the individual and the businessman and their government. So things like the Securities and Exchange Act, revenue acts, various revenue acts. You'll see revenue acts mentioned throughout. National Labor Relations Act, which of course gave private sector workers the right to unionize, and Social Security Act, various banking acts, more revenue acts, the Fair Labor Standards Act over there, which kind of created the national minimum wage. And so there was a whole host of laws that were being spewed out from Washington, and as a result, this is the tax, I focus on the tax laws in particular because just in this 3-year period, Roosevelt considered, all of these changes to the tax code just in these 3 years. And 2 of them were passed, the surtaxes on income and also the tax on retained corporate earnings were passed. So you can imagine if you saw all of these laws coming out in such a short amount of time, as well as these tax increases on business and individuals, that gave people good reason to think that going forward in the future, that Congress and the President were going to try to extract as much income as possible from the very people who make the primary decisions in the economy about investment. So they were rightly very spooked about what was going on. And of course, in the beginning, you don't know how bad it's going to get. You see what it is today, but you don't know how many more things are going to pile on. And there were other things, other threats to property rights that came down. So in particular, many Supreme Court decisions upheld these new laws that were being passed that definitely threatened freedom of contract and property rights further. So for example, Supreme Court upheld state minimum wage laws, and states also passed little New Deal deals, so they're little versions of the big New Deal that they implemented at the state level. Upheld Social Security Act. This was a big one. They upheld the National Labor Relations Act. And sweeping new regulations that were justified with new interpretations of the Interstate Commerce Act, Interstate Commerce Clause. So as a result, you had a new, this historian said that this was kind of a fundamental change in terms of the relationship that the courts allowed between the government and private property and economic liberties. So clearly people, I think, had good reason at that time to think that there was a new framework being imposed on the United States in terms of what business could do and how contracts were going to be enforced and how they were going to be allowed to keep what they've earned and things like that going forward in the future. And as a result, as these protections that people had counted on in the past were weakened, businesses and investors were more threatened and kind of at the whim of the state legislature and the Congress in terms of what types of new laws could be imposed on them that weren't constitutional just a few years ago. Other threats, a big one was the 1935 National Labor Relations Act, which granted unionization power to workers, and as a result, union membership exploded in just a few years from 3.8 million to 10.2 million. They used their membership numbers and union dues to support the New Deal legislation. And they also engaged in things that in the past were considered unlawful. Like in the past, this would have been considered an obvious trespass that law enforcement would have been in their right to arrest. But given these new collective powers that unions had, law enforcement wasn't doing what they would have done just a few years earlier. And as a result, employees were occupying employer facilities, refusing to work until their demands were met. So you can imagine, even if this didn't impact you as a business owner, just reading in the newspaper would give you great pause about, what does this mean about the future relationship between me and my employees? What are they going to be allowed to do that they couldn't do just a few years ago? And how is this going to impact my ability to operate my business as I see fit and to keep the earnings that I want to keep? So it really had a ripple effect, I think, in the conscience of the business community in terms of what they were thinking about what the future would look like. In fact, here's a quote from an economic historian who said, "Business leaders sincerely believed that the government was in evil hands and preparing the way for socialism, communism, or some other type or variety of anti-Americanism." So it was, it wasn't just a lark. I mean, it was a true, I think, feeling amongst the business community that something fundamentally had changed in terms of, how government perceived business and what the rules would be going forward in terms of what business, how they could operate and hire and fire and keep, the earnings that they've generated. In fact, this quote in particular, I think, really is shocking when you read it. This was a question that the U.S. Treasury Secretary asked FDR in a 1937 cabinet meeting. What business wants to know is, are we headed towards socialism or are we going to continue on a capitalist basis? And I think when he asked this question of the president, I think he sincerely didn't know himself, is the impression I get from reading it. I think he really didn't know how far away from the traditional structure of rights that the country had been proceeding along, how much of that was going to change in the future, given how much has already had changed. So, I mean, I think that's a eye-opening question and I don't know how he answered it. That wasn't in the history books, but it would have been interesting to know exactly how he responded to that. So, given all of these threats that were coming along, and given all of the changes in terms of the laws, court decisions, relationship between business and labor, I think people were understandably worried about what the future was going to look like in terms of the structure of property rights going forward. And Bob showed in this paper that as a result, private investment plummeted and it remained at a very low level for more than 11 years. So it extended the Great Depression far longer than it had to be because private investment just pulled back and stood on the sidelines to wait to see how bad this situation really would get. And that's kind of the essence of economic policy uncertainty or regime uncertainty, is this widespread uncertainty caused by changes in legislation and court decisions that then permeates down to the business community. And as a result, businessmen just kind of sit on the sidelines or sit on their hands and they don't buy or hire and want to wait and see how all this plays out. So the question, I guess, that relates to today is, how does economic policy uncertainty or regime uncertainty affect today's economy? Is this just something that happened one time in the 1930s and 1940s and doesn't really have any impact on today's economy? Or are we still kind of seeing this play out at moments when Washington does extreme interventionist policy? And I think we did see this recently and are kind of still experiencing it during the Great Recession in 2008 and onward. We passed a whole host of responses to the Great Recession, takeovers of private businesses and kind of quasi-Freddie and Fannie quasi-government operations, the automakers, huge bailouts of banks and other financial institutions, stimulus programs, investment programs, so-called government investment programs, Federal Reserve policies constantly changing, huge injections of money into the economy, new banking securities, mortgage regulations, Dodd-Frank, Obamacare passage and gradual implementation now. So, just massive changes in terms of new federal programs, new banking regulations, new monetary policies that are constantly changing, the Fed doing things that it never had done in the past. So again, great uncertainty, and the hypothesis is that once again, we saw post-2008 basically the same response by business that we saw during the Great Depression, that businessmen sat on the sidelines and waited to see how all this was going to turn out. So that's essentially the hypothesis, that these actions created widespread uncertainty, led investors not to invest in new businesses and new products, and employers not to hire new workers. And as a result, everything slowed down, and the recession was much more prolonged and deeper than it had to be otherwise. So is there any evidence of this? So I'm going to give you two bits of evidence. One, this is kind of anecdotal statement, 2010, by the chairman of the Business Roundtable, that in his judgment, and it's interesting, he actually uses the phrase, government is injecting uncertainty into the marketplace. But in his opinion and those of the businesses that he represents there at the Business Roundtable, that efforts by the federal government to fix the economy, to stimulate the economy, have actually gone way too far. They've injected too much uncertainty. As a result, they're kind of undoing any beneficial effect that you could expect to have from government intervention. So that's kind of the anecdotal evidence. But in terms of statistical evidence, I think we can say now, after this study was done, that this concept that Bob inspired back in 1997 with his paper has really kind of reached the mainstream. This is a paper done by the Federal Reserve Bank of San Francisco. I mean, there's nothing more mainstream than a Fed bank. Two economists. This is a paper, Uncertainty in the Slow Labor Market Recovery, 2013. So it's just about a year ago that they released this. But what they did is they used an index, a statistical index of uncertainty that three economists developed. One was at Stanford, one's at University of Chicago, and one's at Northwestern University in Evanston, Illinois. And they came up with this uncertainty index, kind of like the Economic Freedom Index, but this one is to measure economic policy uncertainty. So again, Bob's insight has definitely gotten mainstream now when you have mainstream economists trying to measure it. And so they came up with this index, and these two economists at the Federal Reserve, they used that index to try to explain why is unemployment still so high after the end of the Great Recession, which it lasted, 2008, it kind of officially, I think, early 2009, I think it officially came out, out of recession. But the unemployment numbers stayed very high, much higher than what you'd expect historically at this point after the recession ended. And they wanted to explain why. So they tested various hypotheses, and the one that proved most explanatory was this idea, which is their conclusion that heightened uncertainty about economic policy during the recovery has made businesses more reluctant to hire workers. In effect, then prolonged or increased the unemployment rate much higher than it would otherwise be. And they actually calculated what that effect was, and they concluded that the unemployment rate's 1.3 percentage points higher than it otherwise would be without all of this government intervention that we mentioned earlier that followed after the recession, the collapse, or 2 million jobs. So 2 million people, they attribute, are unemployed just due to government intervention into the economy after the Great Recession began. So the takeaway is that government intervention, quote, to fix the economy, can oftentimes create widespread uncertainty, and that uncertainty leads investors and entrepreneurs to pull back exactly at the time when you kind of want them to ramp up, but it causes them to pull back and not make long-term commitments in terms of investments, building new plants, hiring new workers, new capital investments. And as a result, everything slows down. And it sounds like an obvious thing, but it's not an easy thing for economists generally to kind of wrap their head around because it's not easily quantifiable. And generally, economists like things that are quantifiable. And I think that was Bob's great contribution to better understanding the Great Depression, is that he nevertheless pursued an idea, even though it wasn't readily quantifiable at the time. It is more so now, thanks to those three economists I mentioned who are developed that index. But yet he pulled together really good historical information that supported his thesis that business was feeling like they were under assault. And as a result, they pulled back, and now we're seeing it again play out the same thing. So I think it's a real lesson about the benefits of government intervention to cure the economy, quote unquote, and that oftentimes and usually I think it interjects more uncertainty and more doubt amongst businessmen, so it actually prolongs the problems and makes the problems actually more difficult to get out of rather than just letting the economy adjust on its own over time. Questions? Or scores? No scores? No?
Other than that study, is there anything else in the mainstream?
Yeah, there's a lot of them. That actually, I think, is the most rigorous that's been done. And it also, uses that measure of uncertainty that's being kind of perfected over time. My feeling is Bob probably wouldn't think that really captures as much of what he's trying to get at, which, they're looking more at changes in economic policy, whereas Bob is thinking more, how does those changes in economic policy affect people's expectations of property rights? So Bob's is kind of like one step ahead of that, but yet it's a start. I think it would be, it's easier to kind of measure uncertainty than it would be to measure what Bob's getting at, like people's feeling about what property rights will be like 5, 10, 25 years down the road. That would be a little harder, but you got to start somewhere. And I think the fact that such a mainstream operation like the Federal Reserve Bank did a study like that is I think, evidence that it's really reached the mainstream now, and that this concept that wasn't given a whole lot of attention when Bob first published it, but I think it is now. I think it's really reached a level of credibility and acceptance today. And I think it also, though, plays into other people. There's other theories of the business cycle based on investment and fluctuations in investment, Austrian theory and even the Keynesian theory. So, and Bob was careful to point that out in this paper that it is consistent with other theories, and this is kind of a way of explaining what happened that yet kind of blends in with the other theories that were out there at the time.
Is there an index of regime uncertainty? Because we talked about the US here a lot, but in other parts of the world, notably Eastern Europe and other places, obviously there's a lot more regime uncertainty.
Right.
And is there some quantifiable measure of how good a certain country is to invest in, how safe the investment is, just like we bond rate?
No, it's not like the way Bob was using this idea about how secure property rights are going into the future. There's no index like that. Bond rates are actually, and Bob explores that in the paper, they are a good way of measuring what people perceive risks to be out into the future, and if the risk is tied to uncertainty about property rights, you kind of get a measure then of regime uncertainty on bond rate spreads over time. And that's actually a really excellent part of the paper, so I encourage you to read it. I think the paper is also in one of these books. Anthony was telling me, maybe Crisis in Leviathan, I'm not sure which. But yeah, there's no measure like across countries that I know of that have tried to measure regime uncertainty. But I think you're right. I mean, I think it's probably much more severe in other countries than it is here. And Bob, focused on one period in U.S. history where it was very extreme. And I think, again, it was extreme in 2007 through probably 2011 because of all that was being done to, quote, prop up the economy. That was another period. But in other countries, it's like every other year. I mean, they truly have regime change, right? Coups and things like that. That's true regime uncertainty at the most fundamental level. And that would, certainly that drives investment away. I mean, investment abhors risk and flees risk and gravitates towards stable environments. But that would be an excellent area, for anybody here in the room who wants to pursue more research on that in school. I mean, that's a topic that really hasn't been explored. And in fact, I'm sure Bob would be willing to work. I think Bob's going to be here later this week. And Bob would probably be willing to work with anybody who would want to try to put together an index that more reflects his original conception of regime uncertainty, rather than, I think he has a few problems with the one that the Stanford and Chicago economists came up with. But still, it's a start, and I think it does get kind of to the kernel of the idea. Any more? Only once, twice, 3 times? No? All righty. Thank you.